And good morning, everyone. And thank you for joining our webinar, Weathering the Storm. I'm Mona, and I'll be your moderator today. Before I present our experts, I would just like to give you some practical information. And this webinar is recorded, and the recording and also the presentations will be made available for you a few days after the webinar. If you have any questions during the webinar, you can ask them in our question tool. You have a control panel on your screen, and on the bottom there you can see the question bar. So simply just write in your question and send it to us, and it will be answered at the end of the presentation. You can also send us an email at Coface or nordics@coface.com, and we will get back to you as soon as possible. Okay, so the presentation, Weathering the Storm, will be held by our economist, Steenberg. If you have participated in our previous webinars, Jonathan will be familiar to you. As you can see, Jonathan is situated in our UK office, but he is still the regional economist for the Nordics. And he also has a special interest for our region since he is Danish of origin. After Jonathan's presentation, we will have a panel discussion, but sadly our panel is a bit reduced today since our CEO Pekka will not be able to join us as planned. He's out sick with no voice, which is not very compatible with participating in a panel discussion. And nevertheless, Jonathan will engage in the panel discussion with our Underwriter Arnfinn Løv-Mikkelsen. Arnfinn has been with Coface for many years and has extensive knowledge of risk underwriting, both in the Nordics and in the rest of the world. So then I think I'll just hand it over to you, Jonathan.
Perfect. Just to make sure that you can hear me and hopefully see me. So, as Mona said, we will start today with a brief overlook of the world. Not much is happening at the moment, so we can probably cover that in 20-30 minutes. Basically, I'll start here by looking at some different trends. I usually like by starting sort of looking more on the global sphere, and then slowly moving closer to home. We'll also be looking at what's happening with insolvency dynamics and the non-payment risk within the Nordics, and how we see the different sectors. And that will hopefully sort of nicely and naturally lead into to the discussion afterwards. So with no further ado, I'll start here. So just to make sure that this actually follows, yeah. So as you can see here, we have the country risk assessment map. So at Coface, we update this 3 times a year. So the last update here was done in October. And as you can see, we sadly went down to doing more downgrades than upgrades. We had one period, the last one, where we sort of quickly saw a reversal here, but we are back to seeing slightly more downgrades than upgrades. If we sort of start further away from home, generally speaking, when looking at business defaulting risk, so that's unlike sovereign risk, it's focused on non-payment. Generally, if you operate in Europe, North America, we expect this to be one more of these greenish colors. So that's very low, satisfactory, and at these times also reasonable at times. And the further away you get, if you move towards LATAM, Sub-Saharan Africa, Central Asia, usually we start seeing a slightly higher business defaulting and non-payment risk here. So if we start by the 2 upgrades, these were in emerging economies. The first one was Belize. There is definitely an improvement in the economy, but to be completely honest, this upgrade was to a large degree a return to its previous non-payment risk. The Belizean economy is very much based on tourism and foreign direct investment, which, as you can imagine, has taken a while to come back after COVID. But generally speaking, looking at the Belizean economy, its tourism sector is recovering, and its foreign direct investments are looking relatively good, which is why we do believe the non-payment risk here has improved quite a bit. Mongolia has been more of an interesting case in that way. We were quite worried last year, to be completely frank. Their access to hard currency was depleting quite quickly, and this is because their main trading relationship is with China. And as China closed its borders, had its zero COVID policy, that suddenly meant that Mongolia's access to other currencies was depleting, and then the trade relationship was definitely worsening quite rapidly. But as the Chinese economy has reopened, generally speaking, the Mongolian economy is improving as well, and they are also sort of have a easier access to hard currency, even if it's not as good as it is before. But generally speaking, our worst fears, which was that they wouldn't be able to do any payments in anything but their domestic currency, has decreased quite a bit. So we are more optimistic there, which is why we decided to upgrade the country. Looking at downgrades, we can start with Colombia. Generally speaking, the economy has a few issues that are, I think, familiar to people in Europe. They are struggling with high inflation, high interest rate, a slowdown in investment and consumption. And what's particularly hard to not just Colombia, but actually generally several South American economies at the moment is droughts and the fear of the consequence of El Niño. So El Niño is this weather phenomenon that happens sometimes at different levels, but usually causes either intensive rain or droughts in different regions of the world, depending on where El Niño hits. And that's quite a big fear for what effects that'll have on the Colombian economy, especially as that is very dependent on agriculture for exports, and again, their access to hard currencies such as US dollars. So a worsening there would affect the economy quite badly. Nigeria is being downgraded more or less because of the coup d'etat and the economic sanctions, both imposed by international organizations that we in the West are part of, but also the local one, ECOWAS, which is the West African one. And to be completely honest, that is having quite severe consequences for the economy. It's also depending on energy imports from Nigeria, which has been decreased to put some strenuous some strain on the government there. So generally speaking, an economy that is having quite a difficult time after the coup d'etat. The ones that are probably more important to us is the downgrade from A2 to A3 in New Zealand, in Finland, and in Sweden. And these are, while not completely similar, obviously, it is very similar overall trends. We have the global manufacturing recession that we've been speaking about for a while is starting to have an effect on the economies. And as you know, all these economies are small, open, very export-driven economies, usually also in goods and commodities, exporting everything from wood to 5G. And that means when you see this general slowdown, it does have a quite severe effect on the economies. At the same time, what's true for almost all of them is that variable interest rates are more used in these economies. And that means that when we've seen these quick and rapid increases in interest rates, these start feeding into these economies quicker, which means something like household consumption, how much we decide to buy, is affected quicker than other economies, such as, I think the extreme case is the US, which we can get to later, in which they far more use fixed rates for both corporate and household debt, which means that we generally see a slower response after an increase in interest rates. This is obviously also having a big effect on the opportunity to save, given that many people, especially in Nordic, save in their housing, on top of obviously pensions and etc. And sort of high interest rates obviously start feeding into house prices there. And we look at house prices falling in Europe compared to Sweden and Finland, but also Denmark. To be honest, it's fallen a lot more. In the euro area, it's fallen about 2% over the last year, And in Denmark, Sweden, and Finland, this has fallen about 5 to 7% over the past year. So again, you can see this high interest rate affecting these economies more severely than other places. I will though say that what we see now is what we also expect to see other places, but just with a bit of a lag if they have a higher propensity of using fixed interest rates. So why is the map as it is? I'm almost tired of talking about inflation, so I'm sure people are tired of listening of it. But it is still one of the key fears we have, because while headline inflation is falling, and that's a good thing. Again, in Denmark, it's actually going down really quickly. We are still quite worried about sort of persistent inflation. And that is the difference between what we see on the left-hand side, overall headline inflation, what we all fear, and then on the right-hand side, core inflation, so what central bankers care about. And this is where you remove things like energy and food, which are more volatile. And as you can see on the right-hand side, we still see relatively high and relatively persistent inflation if you remove energy and food. And for example, in Denmark, what's really pulling down, it all comes down to goods, whereas service inflation continues to be relatively sticky. And usually you can generalize by saying core inflation is the more stable inflation, that normal inflation goes around when you have the volatility that's usually caused by changes in agri-food and energy prices. So if this overall level continues to be higher, well, then it's quite hard to get inflation down. And that means that central bankers will have to keep interest rates higher for longer. As we can see, a good thing that we're finally starting to see is a slowdown in, I'd say, the last two bastions of inflation in the Nordics. And that was particularly Norway and Finland, which far longer than many others saw continuously rising core inflation. But as you can see, we are seeing a slowdown. But again, this is quite slower than we would like to see, and also slower than what we're seeing in other economies. And this is really the persistence, often stemming from, among other things, the service sector and higher mortgage rates. The sort of the irony of higher interest rates to lower inflation is that on the short term, it will increase it as mortgage costs are part of your consumption basket. So higher service inflation and higher mortgage costs are keeping this inflation level up. And why we are particularly worried about this is that we are going into a winter. In case you haven't noticed, it's usually something we do notice in the Nordics, and that means that we do start fearing about energy prices and energy supply. A good thing is that unlike last year, we are in a pretty good situation. You can see that on the right-hand side. So when I say that, there are less energy than before, I can just start by adding that the fear that we will run out of gas is smaller than it was last year. It's not completely impossible, but it is highly improbable. To be honest, because as you can see, we are in a really good position where we actually have the highest amount of gas storage in the last 12 years. That would be. But as you can see, we are now starting to deplete from it as we are going into the cold months. What this will mean from a pricing point of view is usually as we start using energy, the demand increases as you will start seeing some countries starting to buy in here more as we are using it more, and that will usually have some inflationary pressures on the prices. Generally speaking, natural gas prices came down from last year. They went down relatively quickly towards the middle of the year and have been coming up since then. And generally speaking, what we would like to highlight is the fact that energy will be higher. It will be more expensive because there is less supply than there was before. And that really comes down to geopolitical pressures, which means that unless the relationship with Russia improves, we need to build up the capacity from other places. And this will take a long time. We have been able to get the energy from other sources so far, Norway, for example, is producing and contributing more to this. We are being able to get better at building it up throughout the year, but this sort of means that we have a less elastic supply, and that means changes in demand will result in more volatile prices. On top of that, the other geopolitical tensions right now, which is a new war in Israel-Gaza, actually also do have consequences for this, as maybe not many people know, but there is some natural gas production in this area. And for example, when the Israel-Gaza war started, what happened was that the border between Egypt and Israel closed, which included the gas that was exported between the two coming out from Egypt, where they can make it into LNG and export it to Europe. So suddenly the war in Israel-Gaza had an effect on natural gas prices in Europe through this. And that's also just to highlight that geopolitical tensions continue to matter quite a lot right now, which means that small variations and intensifications of these sort of aggressions will start having effects on the prices. And we see that in Brent oil as well. Obviously, the war between not Israel, Gaza, Hamas and Israel is having some effects on the oil prices. It is a bit interesting what it will mean, because right now with both these aggressions, with a unknown recovery in China, which I will get to later, a US economy that seems to be slowing down but still showing some sort of strength at times, that means that we are seeing many changes in what we assume to be demand coming from mainly US and China, and potential supply coming from either an intensification and potentially expansion of this geopolitical tension in the Middle East, which also means that somewhere like OPEC is suddenly not sure about what to do. They had made it very clear they are planning to cut supply. If we hear someone like Saudi Arabia, they are still planning and still suggesting that they should stick by the supply cuts even throughout the majority of 2020-2024 now. But looking at some other participants in OPEC, they aren't as sure about this. They are seeing this affecting their national economy, their national budget, because again, many of these countries, this is a very important part of their income. And suddenly start to question this, which is also why the prices for Brent oil at the moment are very volatile, because so much of this comes down to where's the demand outlook looking in the US and China, where's the supply outlook looking mainly from OPEC, but also what are the potential shocks coming in there with the intensification in Gaza being sort of the main fear around this. But on top of that, you also have the US potentially intensifying their sanctions towards Iran as a consequence of their interaction in these conflicts. That would again have quite a big effect on the oil prices, as well as Europe potentially stepping up their sanctions towards Russia. Not necessarily the severity of it, but how, it sounds weird to say, but how serious you take this. For example, I think Iranian oil is one of the best examples of this. There is a lot of sanctions towards Iranian oil, and that means you can't export directly from Iran. But what usually happens is that oil is then moved to Malaysia and is exported from Malaysia, despite the fact that Malaysia doesn't have oil. We all know this, but we still import oil from Malaysia. But obviously, this is one of those things where people know about this, and you have the sanctions, but if you don't want to enact them as harshly, you sort of accept this. But if you choose to say, no, we want to act more harshly, that again starts meaning you suddenly start slowing down how much you can import from them. And that will again have an effect on the energy prices. So there's uncertainty around supply, demand, and potential shocks to this, mainly regarding geopolitics. That means that we expect a lot of volatility around prices that companies need to be aware of at the moment, that, you know, slow and steady is not a given anymore. The Chinese recovery is something I do want to briefly comment on because it has massive effect on both the energy markets, but also especially the European economies. The saying is that when China sneezes, Europe catches a cold, and that is very, very true. We are seeing somewhat different pictures coming out of China. In some ways, we are seeing some improvements, and in some ways, it is still a disappointing story. So I think both can still be true. We are seeing some improvements in China, similar to Europe. This is so far a relatively fine service sector recovery. That is, people are still going out traveling. You know, you're going back into going to restaurants and other sort of entertainment, which means the service sector is improving. But looking at the manufacturing sector, this is still struggling, and this is again this global manufacturing recession that we are seeing is having a big impact on the economy, and that is more or less due to three main reasons. Domestically, the demand is low, and that simply is that after the lockdowns, we've seen a small but not impressive recovery in consumer confidence, and what people have been buying has to a lesser degree been goods. Again, as I said, the good story has been centered around the service sector, which means that Chinese manufactured products are not selling as much in China, with the exception of certain goods. But as a whole, this has not been as impressive as many had hoped from the reopening. And this is partly due to the second reason, which is the real estate sector. Many people had the vast majority of their savings in real estate. And as you probably all read in the news, the real estate sector in China is still very weak. And that was initially started by a crackdown on leverage within the real estate sector that suddenly starts showing some cracks that were already there, but maybe less known, and maybe people just turned the blind eye to it. But suddenly you realize that the model that they had wasn't really tenable. It was usually driven by debt from people buying a house, putting down an early down payment. That down payment was used to build new houses, which is again a scheme that works very well if you see this continuous increase in housing. But the problem in China is they've been very good at building houses. It's been a key driver of the economy. If you add both construction and real estate, some people say it's been about a quarter of the Chinese growth. But that also means that right now you are looking at, especially in tier 3 and 4 cities, so not the very, very biggest, but the second biggest ones, you have a massive oversupply of houses. Between, I think it's 50 or 80 million is even some conservative estimates of how many flats are still just empty. And if you look at house ownership in China compared to US and Europe, it's actually higher. About 90% of people already have a home. So you have a system that was built around building more and more and more houses, but you've been so good at it that perhaps rightly so, people started questioning, well, is this really tenable? That is what the government tried to crack down on it, saying we need a more sustainable business model. But that obviously means you have some time for adjustment. That means that people will lose the confidence in the system, will be less inclined to buy at the moment because they're not really sure about how strong this business case is anymore. And that's essentially what we're seeing in China, is people are more hesitant and are saving a bit more because they're not really sure how their existing savings are looking when looking at how house prices and the overall real estate sector is going in China. And the third reason is geopolitics. It's the relationship with the US. And that is the fact that exporting their way out of a crisis, which they have been able to before, is not really possible this time around. And that comes down to the fact that we are seeing a not decoupling of the global economy, but definitely de-risking. And something people often ask me about is are we actually seeing this for real? Are we actually seeing this change? And what I'd like to highlight here is that the biggest exporter to the US from 2008, after the great financial crisis, to the second quarter in 2022 last year was, with the exception of one quarter, which was COVID, was China every single quarter. But for the last 3 quarters, it's been Mexico every single time. So we are seeing this de-risking. That does not mean that the US and China won't continue to trade. I think both of them understand their interdependence on each other. Both of them also understand that if this relationship worsened a lot more, what kind of escalationary potential that could have. But we will see this slow decoupling, and somewhere like Mexico is really benefiting from this, because from an American point of view, it is closer. It is maybe not friend-shoring, but is definitely near-shoring. And if you look at the exports going from Mexico to the US, they also have a lot more American components. So even American companies benefit from this being reshored closer to them. So the Chinese recovery is going to be slower. We are seeing some good signs, but basically they will have to recalibrate their domestic economy and their international one, because things have fundamentally changed before and after COVID. So looking closer to home, one of the things that we watch quite vigilantly is the labor market. One, because it has something to do with our purchasing power. You know, if we have a job and a higher income, we usually buy more things, but also because it's one of the things that we know central banks are very keenly watching, because they are fearing this price rate spiral, which is, if we have a very strong labor market and we see strong inflation, then we have a higher inclination of wanting a higher salary to compensate for it. And if we have a very tight labor market, then we have more bargaining power. So what we know central bankers are very, very focused on at the moment is the strength of the labor market. And one of the reasons why they were that worried is because of the trend that we saw from 2021 to 2022. And that is that vacancies started coming up very quickly, more or less in most of the developed world, to be completely honest, but as you can see, also very clearly in the Nordics. And that is simply that the reopening of the economy suddenly meant that we had to recalibrate, but actually sort of change what our needs were in certain sectors. And a lot of people obviously changed jobs, a lot of the people were let go, which meant that suddenly we had a change in what we wanted, which means there was a bit of disruption here that needed to come back. And that meant that we suddenly saw this very, very quick increase in the vacancy ratio. Now, as the economic activity level has been slowing down, we have seen this come down. People are in some ways finding jobs in new sectors, or finding their own job after this disruption during COVID. And that has meant that we are slowly returning to a more normal labor market. But as you can see, for many countries, we still have this slightly higher job vacancy ratio. Some of them is coming down. For example, Finland is more or less at the ratio they were beforehand, which is an indication of, again, a slightly weakening, but still, I'd say recovering labor market. And looking at unemployment, what we're generally seeing is the US is very low, albeit slightly increasing. The Eurozone is actually quite low still. The European unemployment rate is quite uniquely low from their historic standards. And when we look at the Nordics, we are seeing some increases from the very lowest levels, but generally speaking, there is an increasing trend, even if it's coming from a lower level. Where this is most clear is Finland and Sweden, where, as you can see, these are the light blue and the yellow one, we are seeing an increase. And for both of them, which is, it's unlike many of the other economies, we are back at or above the 2019 level. So it's not just coming from a low level, it's actually higher than what we were seeing before the pandemic. So there are some signs of weakening in the labor market, particularly Finland and Sweden here are examples where you can see it slightly more clearly. I will say though, if you look at employment, it is still relatively good many places, but with vacancy ratios coming down, with unemployment rising, we are definitely seeing some signs of a weakening in the labor market. And this is having an effect on the economy as well. On the left-hand side here, I've added the most recent GDP figures or GDP indicators. As we can see, Denmark and Norway are actually seeing a slowdown. I will say for both of these, I sort of say that the key industries are skewing the data a bit. In Denmark, this is a slowdown in the pharmaceutical industry. That's a big part of this, to be completely honest. It also was one of the reasons why the economy was as buoyant as it was until now. But as the pharmaceutical industry is slowing down, it is now so big in the Danish economy that we can actually see it on the figures, which means we are seeing this slowdown. But in Denmark, this is mainly centered around this. And Norway is, again, a similar story. This is not mainland Norway GDP, which removes oil and gas, but includes these. And if you look at mainland GDP, we are still posting positive figures in Norway, albeit very, very slow. So we are around, 0, 0.1, 0.2. So a stagnating economy, but not necessarily falling. But Finland and Sweden, we are seeing a downturn. In Finland, I will also say that the Q2 figures were slightly skewed by the fact that net exports contribute very positive, as well as government spending. So if you look at the business economy part of it, that was already slowing down quite a bit. And we're also seeing this in the confidence figures. Again, if you look at somewhere like Norway and Denmark, we have sort of seen that bottom out a bit, and it's sort of averaging, and even in Denmark it's improving a bit, despite the fact that the overall GDP figures are showing different things. And that's again the fact that overall GDP here is slightly skewed by the fact that you have these very big industries. In Sweden, we are seeing a maybe bottoming out. I would not be surprised if we maybe see a slight decrease there. And as you can see in the Finnish, we are seeing a continuous, albeit maybe not as quick fall in the business confidence, as these high interest rates and overall higher energy prices are having an effect on especially the manufacturing part of the economy. But what we're also seeing, what we're a bit nervous about, is that the service sector is also slowing down a bit. And this is lastly where we are quite worried. Something we'll talk about later, so I won't go too much into it. Is the retail sector, but generally speaking, we saw quite a lot of goods being bought, so retail sales doing relatively well during COVID, and that's the fact that we couldn't use services. But as the economies normalize, we could start buying more services. That's hospitality, restaurants, etc. We started buying less goods, and now as our real disposable income fell a lot during the last 2 years, at the same time as some of the savings we built up were depleted, we saw this feeding into not just the goods, but overall household consumption, which is slowing down. So that means that while we're both seeing a change in what you're buying, so relatively speaking, are you buying more goods, retailing, are you buying more services, hospitality, holidays, etc., both of these are indicating less goods overall, and that is what we're seeing. What's impressive is that the Norwegian figures are probably the most negative here. Some of this can be skewed by the fact that comparatively speaking, there was a lot of buying in 2022, especially of electrical vehicles that kind of skewed this data a bit. Once again, I think the more positive story here is that the Danish retail sector, generally speaking, fell quite quickly, but has somewhat been recovering as we saw this fall in inflation quicker than other places, which has improved consumer confidence somewhat. So what does all of this mean for interest rates? Well, generally speaking, we do believe we are around the top of the cycle now. Our main scenario at this point is probably unchanged interest rates across the board. The US we do expect to hold. There are still some people fearing another hike, but our main scenario at this point is that they will hold probably until the middle of next year, where we do expect we can slowly start seeing a gradual fall. The Eurozone is a somewhat similar story. They are struggling with high core inflation, similar to the Nordics, which means that they will be somewhat more hesitant in starting to cut interest rates. But the economic activity level in the euro area is that much lower than in the US, which may help incentivize them starting to cut earlier. However, even when these cuts happen, what we want to highlight is that these will be slow and gradual. Unless we see a serious downturn in the economy, these will be slow and gradual, which means we won't go from the 4 to 2 in 6 months. It will be a slow and gradual process, which means that the overall outlook for interest rates are, generally speaking, still higher. And some economies that we could maybe fear would be forced to do hikes, and that's why I've added it on the right hand side here, is potentially Norway and Sweden. While I think the central banks would, generally speaking, like to hold, similar to what we're seeing in the US and Eurozone, as I think in particular people living in those countries know, we have seen a weakening of the currency, which is inflationary by nature. You import inflation if you see a depreciation of your currency. If this were to worsen, we could potentially see the central banks in Norway and Sweden being forced to hike again, simply to strengthen their currency somewhat towards the dollar. But again, I would say, ideally speaking, they would not want to do this. This would more be a measure to improve the exchange rate somewhat. Lastly, why we care about interest rates this much, particularly in the Nordics, and I already alluded to this earlier, is the fact that debt is in the Nordics not centralized around the government, which it is more in the US and Eurozone, but very much in households and in non-financial companies. And we're very fond of variable interest rates, which means that companies in the Nordics are, generally speaking, very sensitive to higher interest rates and these changes. And as you can see, if you look at the average interest rates in, let's just say, Finland as an example, we were around 1.5% up until sort of start Q1 2022, and we're now operating in a 5.5%. Now, as you can imagine, if you have a variable interest, you're already feeling the brunt of this, which means that we are, vigilantly watching ICRs for companies, so the ability to cover their debt, because obviously, if you had a semi-good business case beforehand, even that one's being questioned when suddenly your debt starts costing 3 times as much over a year. And as you can see, it's true for almost all Nordic countries that we have quite a lot of debt centered around our non-financial companies, which puts them at a higher risk when we see this higher interest rate environment. I'll quickly go through the last here because I realized I talked slightly longer than I was supposed to. But generally speaking, our main expectation for the world is still stagflation in advanced economies. That is low economic growth, higher than we'd like, inflation, which means that we will see a slow recovery. We'd probably still see a downturn in some countries, but we don't expect something like a recession. That is not our main scenario. Is still a possibility. And a lot of this will depend on how the US economy fares next year, but our main assumption is still that we will see a slow economy. But something we're quite nervous about, and I'll get to that in a second, is what this higher for longer will mean on a micro level. So on a macro level, we might see a relatively slow recovery, but on a micro level, having these higher interest rates for longer, that will start having a big impact on individual companies' balance sheet and their ability to survive in this sort of environment. And I will just highlight here, because I do need to stop this in a second, is the fact that many of the things I've just highlighted are not just the short-term changes. Some of these are fundamentally things that will be different from the even 5-year horizon, perhaps even 5 to 10-year horizon. We are seeing higher geopolitical tensions. We are seeing populism, which means that some of the efficiency gains we used to see from a globalizing world, where we basically got efficiency gains from outsourcing work, from importing cheaper labor, that is becoming more and more difficult. We also want safer supply chains, which will again mean that we friendshore, we reshore. That will be more costly, to be completely honest. And lastly, with the Ukraine war, we are also seeing energy prices, generally speaking, going to be elevated and more volatile until we're able to somewhat cover what we used to have here. So that means that we do expect, generally speaking, to have higher costs, higher interest rates, which will start feeding into lower GDP growth. And if we see improvements in growth, that will be more inflationary. And I will go straight on to what we're actually seeing here in insolvencies, and that is that everywhere, and I'd even say that we are slightly below, even Norway has now returned more or less to its pre-pandemic levels, which means we are seeing now in 2023 a proper normalization of the insolvency proceedings in all the Nordic countries. We have, generally speaking, seen very low levels in the last few years. Part of that was government support. Part of that was also just a build-up of general liquidity in many companies, to be completely honest. But as the inflation started feeding into this, as the outlook started to deteriorate, as these government support measures are phased out, we are now seeing this normalization in the dynamics. This is somewhat slowed down in Denmark, but we are still seeing increased non-payment risk here. Again, Finland, as you can see, we are seeing a quite clear upwards going trend, which we are also seeing in Norway and Sweden here. I think the acceleration on year-to-year basis is highest in Sweden, where insolvencies have risen by about 30% year on year, which is about 27 in Finland as well. So we are seeing a very quick acceleration in insolvencies. But this will always sound more severe on a year-to-year level because we come from a low level. But just to keep that in mind, that we are seeing a quick increase in non-payment risk. I will not go through much detail on sectors because we're going to cover those in a second. But just generally speaking, we are seeing increases in most sectors, to be completely honest. The ones we are most worried about are the ones that are very, very sensitive to changes in consumer behavior and unable to pass on these costs, very sensitive to interest rates, and lastly, generally energy intensive industries are struggling right now, especially with the competitiveness with American peers. So I will stop here and apologize to Arnfinn that I think I went slightly over what I was supposed to say here.
Okay, thank you, Jonathan. I cannot see that we have gotten any question from our audience. So then I think we will go straight over to our panel discussion. We have the panel discussion will mainly revolve around 3 important sectors, which is the construction sector, non-food retail, and energy. And if you would like to ask our panel questions, please just use our question tool as previously explained. And then I think we'll just dive straight into it, beginning with construction, which is of course a very vital sector for the Nordic and is currently struggling with high insolvency rates. So I think I will just ask the panel if it's just black and white in constructions, or if there are any subsectors that stands out.
Arnfinn, would you like to start?
Yeah, I think it's a good question, and obviously I think it's really some dark clouds over the sector in particular. I think it's especially with commercial and residential real estate, with increased interest rates, and that makes the market conditions soften. And as you said as well, the bankruptcy data shows also increased bankruptcies within the sector, and is back to the normal. But also we see to some extent that other industries related to this sector, like architects and staffing companies, also have some problems. So I think it's mainly the darkest clouds are within the building part of the sector. I don't know if Jonathan, if you have any comments to that.
No, I mean I completely agree. We usually sort of generalizing, saying we look at the construction as, I think, 3 or 4 different sectors, depending on where you put construction material. But residential is somewhere we are seeing demand just completely plummet. Again, high interest rates have both an effect on the supply side, how much it costs to build, but also on the demand side, because we need to be able to buy it. And when we see interest rates as high as they are now, that will usually start feeding into house prices, which means that you are building at higher costs, either your input or your interest rate cost, and you're selling at reduced prices. And again, as I said, if you look at the house prices in anywhere but Norway, they're down by more than 5% year on year in the Nordics. So that really highlights the residential sectors is having quite a difficult time. Commercial, completely agree. It's basically you finance by interest rates, and the value of your property also depends on interest rates. Your loan to value, that is the value of your assets, is all interest rate related. So the moment that starts increasing, your assets start losing value, and your costs start increasing at the same time. So commercial real estate, yeah, definitely having a difficult time as well. The one where we are slightly more optimistic, and I think you'll agree, is infrastructure, civil engineering. We are lucky in the Nordics that we have relatively strong governments when it comes to low debt levels and an ability to invest when needed, and we do expect and do see some signs of them actually wanting to invest some money at the moment, which means that civil engineering, generally speaking, should fare slightly better at the moment, and that is also what we're seeing when we're looking at surveys on what are the biggest issues for infrastructure compared to, let's say, residential. They actually highlight still shortage of specialized labor as their biggest worry. It's not insufficient demand, it's actually shortage of specialized labor that is still their biggest worries. But that is again a good sign that we are still seeing some demand in the infrastructure sector.
Yeah, and I think also in like with the fiscal policies as well, with the budgets, I think the governmental sector will probably be quite stable in terms of demand, and I think at least from the larger construction companies, we see quite a good order book as well. And for the future, I think probably also the energy part of construction will probably see some. Not the recovery, but I think some good prospects going forward with especially the building of grids and even renewables. So I think it's the best position to be with in terms of risk. I think is the more larger corporate is good positions, as well as of course the niche ones with a lot of smaller projects maybe, and also a lot of maintenance orders in their books with good balance sheets. I think that's a good place to be in terms of risk.
Yeah, definitely. If you're heavy in repair and maintenance compared to mainly being focused around new building, new construction, you usually would fare slightly better in these. And if you're just focused on building new, that is usually one of the most cyclical parts, and we are also seeing that in where we're seeing the highest insolvency rates by subsector within construction.
So yeah, and also when we talk about bankruptcies, we also, of course, in Coface we receive late payment notification as well, and what we can see is that we see like smaller enterprises are more often at those lists and the larger corporates with more diversified portfolios. So that's what we see from day to day.
Yeah.
Well, yeah, that was actually maybe a good sum up of the construction sector then, Arnfinn. That if you are going to go into construction, maybe look for the bigger companies.
I think it's a good place to be because of the diversified order book. Of course, with when you look at underwriting, it's always good to see a good balance sheet and probably a good backlog of projects and not be positioned in one large project.
Great, and I actually have a question here from our audience, and it says, during the seminar in October, we spoke about the domino effect. Would this have an impact on your risk underwriting in the construction sector?
Do you want to start, Arnfinn?
Well, it's of course what we touched upon before, that in commercial and real estate we can see some probably domino effects going forward, and I think when we do our underwriting, we are very aware of financials and follow the companies very closely in terms of their profitability. So it's that's the way how we try to maneuver in this it's difficult environment. But of course, with the possibilities of interest rates dropping a bit, the market conditions could be better in 24, as Jonathan has touched upon in his presentation. So we're of course looking very closely to the performance of the companies, and I need to have a very tight focus on the performance.
Yeah, but domino effects, it's obviously something we're worried about in many avenues. Again, if you have a lot of small companies going insolvent, that at some point can start affecting bigger companies as well, if those are their contractors to them, etc., and they start seeing. So sort of smaller companies can start affecting the medium-sized and then the larger companies as well. So again, this fear from the micro starting to build up and affecting the macro is something that we can see, and we maybe will see in some sub-segments. But generally speaking, we are expecting a somewhat slowdown in the sort of interest rate pressures for especially companies that have majority variable interest rates. So they will maybe see some easing next year. It's maybe even some of the bigger ones that are currently operating on fixed terms, maybe financed by bonds, that will suddenly see that immediate shock when they need to refinance a corporate bond.
Okay, I think maybe that will be the last word in the construction discussion today. And if you have more questions about construction, please feel free to submit them to us either via the chat here or in or email nordics@coface.com. And then let's talk about shopping. This is a big and volatile sector, and which is right now in its peak season. I don't know, you might have noticed it's been Singles Week, it's been Black Week, it's been Black Friday, it's been Cyber Monday. But what will happen after Christmas? What trends can we anticipate going forward? With other words, what will people buy next year?
I think I can maybe start this time, and I will try to be, which is not usual for me, try to be slightly optimistic. We have seen, according to at least some, that we actually saw a relatively good Black Friday. We have figures from Vipps in Denmark and Norway. We have from Klarna in Sweden that overall said they were seeing quite strong figures for their Black Friday sales. Again, there's a bit of bias here. They're still growing popularity, so that will obviously be a bias here. I guess somewhere like Klarna, you could contrarily argue that if people are buying with Klarna and paying later, that could be an indication that they're actually having some issues in paying for things right now. What I think we could maybe see is a slow start to next year. People will hopefully see a pretty decent Christmas, a slow start to next year. But what we're expecting from wage growth next year compared to what we are expecting from inflation, even though it's higher than the 2% that central banks would like to see, we are expecting a positive net growth in real wages next year, and that will hopefully start feeding into the sort of middle segment of retail, which means that we could see some improvements simply coming from the fact that people are seeing slight increases. Now, the caveat of that is that we're also expecting unemployment to go up a bit, which means that we will see some people not being able to buy what they did before. But we do expect a certain segment of the economy potentially starting to have a bit more purchasing power, and that will improve it somewhat during the middle latter half of next year. But what do you think, Arnfinn?
Well, I think on the demand side, I think it's also going to be quite stable. Maybe it's with the new prospects in terms of the interest rates. However, from the last year, it seems that most of the retailers have, or the best one have adjusted their inventories. So I think the good companies have done that through 2023, and I see at least for October a lot of sports equipment companies have had positive sales. And I think going into 2024, I think the best performance probably will be the companies that have done this job, probably taken some losses in 23, reducing their inventories, having a sound balance sheet going into 24. And I think probably the worst companies probably will be those that hasn't done this job and has a lot of inventories that they have to write down. But still, with the pressure on disposable income, I think also going into 24, probably the lower price point type of non-food will be the place to be if you are a company like Rusta, Clas Ohlson. I think that those companies have reported quite a good performance, also the Q3. So that would be my guess in terms of best performance.
Yeah. Now, because I will say, if I need to put on my negative hat again, where we are seeing some disinflationary issues around goods, and it's companies being forced to cut prices in order to still be competitive, with the fact that people are slightly more selective of where they're buying. So we are definitely seeing some companies within the retail sector seeing quite a squeeze in their margins, especially somewhere like household goods. So that is your sofas, your dishwasher, your fridge, etc. We bought a lot of this during COVID, and some of that basically means that we've already bought what we needed to buy, and those are generally things that are quite expensive to have in your inventory. They take up a lot of space, which means that you suddenly, when you have to start writing down those, will start affecting you quite seriously. This negative hat is far more comfortable.
Okay, well, thank you so much, Jonathan, even though you had your negative hat on. I can see that the time is, we are almost there. It's almost 10 o'clock. I think for the last sector, we just need your, I think we just will have your key points. If you have some, just do the summary so that people can bring that with them when they leave our webinar today.
So,
well, from the energy perspective, I think it's really divided into two, that you have the oil and gas really performing very well, and the supply chain having a lot of prospects. I think it's the companies in the value chain has also restructured now the last 3-4 years, so the balance sheets are much better. So I think in oil and gas supply chain, I think the value chain and the manufacturers are really good positioned, while in in renewables, I think it's much tougher. Now with the interest rates, a lot of projects are in the beginning in the investment phase, and also before that. So with the current interest rates, I think a lot of the projects have been postponed, and suppliers in this value chain is having a more difficult time, like Vestas, Siemens, and Nordics, in particular with wind, and in solar. It's the prices on panels are low, but the grids are not there for accommodating new power plants, so they struggle a bit. And also the value chain with solar equipment, it's hit by Chinese oversupply. So I think they're struggling a bit within solar as well. So I don't know, Jonathan, you can maybe have some remarks as well.
To be honest, I feel like you summed it up very nicely. Oil and gas, we are less nervous about. Again, you could downstream, midstream, upstream. Again, if you're actually doing the exploitation and production, so that's the more downstream part, you're in a pretty good position when prices are high. Some refineries along the way had to adjust, but as you said, I think most of them have done relatively well and will also still benefit from the higher prices. We are seeing some upstream, so that's the actual sellers being hit by the higher prices. Obviously, higher prices for gas and oil will have a demand effect. So if you are in the very last part of this, you might actually see less demand, and you might in that way your margins might be squeezed a bit to try to still recoup some of this. But the vast majority of oil and gas, we do see a pretty strong business case there. Wind and other renewables, yeah, definitely struggling. Especially wind sort of has the curse of construction. You put out what you expect your cost to be, what you expect to sell it for, and usually there's a long wait between the two, especially when it comes to offshore wind. And that means you do have a pipeline right now for several of these offshore wind producers. That means they settle for some costs, which they're going to have a hard time honoring now, especially compared to the prices they agreed on. So that is definitely a business case that is quite difficult for some of them. I'll be optimistic here and say I do believe governments will step up here and offer higher prices in the coming years, as they can see that the business case has changed from what it was before. And for example, in the UK, they've already, since they had 0 offers on this year's offshore wind, I think they've talked about increasing the minimum price by about 60 to 70% next year. So really, when it comes to offshore wind, the biggest one here will be, do governments, can they talk the talk or can they walk the walk? Are they ready to spend the more money to make sure this is still profitable?
Okay, thank you, Jonathan. I think we will stop at your optimistic note there. And you see, time fly when you have fun. So it's 10:04, and I think it's about time to say thank you both to Jonathan and Arnfinn for participating at this webinar and for sharing your insights. And thank you to all our participants. Wish you a good Tuesday, and hopefully we see you at our next event. So thank you and
thank you.
Goodbye.
Bye-bye. Bye-bye.